Thank you very much, Mr. Chairman. Thank you, Ranking Member. I'm glad you're having this hearing, and thank you all for being here. I just want to I want to shift the question just a little bit. You've been talking some about the transition and mixing within that where we're trying to ultimately end up. The question I want to ask is, what is the center of the bullseye? However we get there by transition, what exactly are we aiming for? And I read your testimony, I listened to all of you, and I just want to see if I have this right across the board. That you all favor layering the risk between the private market and what the government has to do publicly. That you all favor making explicit the guarantee that's there, that Fannie and Freddie or whoever we call them, whatever names we give them, are making, and then make people pay for that guarantee that they're getting. And that the two variables, the sort of hard nuts to solve in this, are how you ever get the pricing right when the government's doing the pricing, and then how you get the layering details right, that is, who steps in at what point. And the reason for that is that it bifurcates into 2 points in time. One is that you're worried about the lending incentives, that is, that the private market is out there with the right set of incentives. The government obviously is rather different on that. And the second is whether or not you've got adequate loss-bearing capacity if there's a collapse. Is that a fair description? Because if it is, we need to know that that's really the center of what all four of you at least are anchoring in on. And to the extent it's not, I just want to hear from you. So that's why I put it out there. And yes. Dr. Van Order, maybe you'd be the right place to start.
I particularly am interested in the incentives, because anytime you have structures like this, which are good, there's always the potential for moral hazard. We used to call this unbundling. The traditional bank savings and loan took all the risk. The securitization process unbundled it. That's neat. It goes back to our founding father, Adam Smith, and the division of labor. The problem with it, as you do that, as you get along the food chain, you've got the moral hazard problems. People can abuse one another. I think these are the right structures, but I haven't seen any in them that really makes sure that sort of thing doesn't happen. And it happened like crazy a few years ago. It happened in the private label market. It happened in all sorts of situations where people didn't feel they had a stake in what they were selling to other people, or they wouldn't get caught. And so I like capital, but I really think you need to worry about the incentives at the level of management and the companies to really perceive themselves as being on the risk all the way down, not just for a little bit of it.
No, I understand your point, but I just want to make sure that I'm locked in on this, Dr. Van Order. And that is, while you'd put the emphasis on the incentive question, and others might put it in other places, the basic structure as I described it is where you'd end up. I just want to be sure on that. Okay, good. Let the record reflect your nodding yes. Okay, good. Yeah. Dr. Swagel, I was just going to come up the line here.
Oh, sure. I was just going to, so I agree. I wrote it on the list, and I agree absolutely. And the emphasis I would add, since we're going to agree and add emphasis, is on the shrinking the guarantee. So make it explicit, because I think it will be there. If you don't make it explicit, it's implicit. But then shrink it, right? Protect taxpayers, provide better incentives, and then I think that also helps address the
Dr. Swagel, let me just push back.
Yeah, please.
How do you shrink it? If at the end of the day we talk about a Fannie and Freddie that had no explicit guarantee, and yet when it all falls apart, when the market falls apart, the answer is the United States taxpayer is called to come in and backstop.
Yep.
So I don't even understand what it means to say that part of the target is to shrink it.
So I would use the tools that I mentioned. So I have more first loss private capital.
No. I'm not asking you tools to shrink it. I'm asking you how the end can be to shrink it in a world where you've got the guarantee. If the world falls apart, the U.S. taxpayer will be called on to come in. Every single player in the marketplace after 2008 now knows that. And so I don't see how it's anything different from we price for it, and we try to figure out how to layer in a way to deal with the incentives. I just don't understand how you can talk about shrinking it.
Well, it might be a semantic difference. In my mind, shrinking the guarantee is when the government covers less than every conforming mortgage, and when there's first loss private capital before the guarantee.
Well, this is the layering question. That was the second half we were doing. So maybe we are in the same place then.
So it's really just a matter of, how much layering, and then what's the market share of the government.
All right, fair enough. Fair enough. Mr. Davidson?
So I guess my main maybe adjustment to that thought is that I think there's different segments of the mortgage market that are going to have different structures to it. So, for example, there's the FHA portion where the government is providing the credit piece and the wrap on the MBS. Then, in this other layer we've been talking about, like sort of what's currently the GSE market, that's the area where we have the multiple layering of private capital and government guarantee.
But let me ask, Mr. Davidson, do you have any doubt that the government implicitly backstops the entire market?
So, the government did not backstop the AAA private label bonds, which are now trading at 50. So it didn't backstop the entire market. What the government did was step in and said, we will make sure there's new mortgages that will stand behind. But it did not stand behind the private label, MBS. It didn't stand behind the CDO market.
Well, one could argue respectfully that when you step into a market that has collapsed and offer funding into it, you have backstopped that market. Yes, we impose some losses, and this is what I was talking about. That's what the layering does. It imposes losses, but it doesn't change the fact that the government is the one that still backstops the entire market.
Yeah, I guess what I'm saying is I want to segment backstopping loans that already existed and backstopping new loans. Clearly, every new loan is now guaranteed fully by the U.S. government, but there are loans that were originated that are not being backstopped by the U.S. in the legacy book.
Yeah, fair enough. Fair enough.
So,
Dr. Willis?
So I agree that we should keep a guarantee on the MBS. I also agree that the government's going to come in if there's a systemic failure, and so we might as well charge now and build up a reserve against that contingency to protect the taxpayers. I think there is a role for private risk ahead of that government wrap. I think we should test for that to see what effect it has. There are ideas. Senator Corker's not in favor of the MI, and I don't think anybody wants to defend the way it was, but there are a lot of changes, perhaps in how they, rescission rules, capital, all sorts of things with regard to insurance, and you could talk about them even taking a deeper loss than on the above 80-20, they actually take 35%. There also we're tightening reps and warranties, so that is a way to do risk. So there are a number of ways to do that. As for getting the pricing right, everybody wants to point out the government didn't do it well. Well, quite honestly, FHA, the loss is relatively small here, particularly compared to what the private sector lost here. Ginnie Mae is still doing very fine here. I don't suggest that the government not charge fully based on the Fair Credit Reporting Act accounting here for the risk, but I will point out that if worse comes to worse and they make a mistake, we have ways of, the government isn't going to go out of business, and it can survive, and people disagree about this, it then can raise the rates and pay itself back, in a sense, by penalizing future borrowers, but that may be a fair way to do it.
Thank you, Mr. Willis. I appreciate the difference in focus for each of you, but I take it we at least understand the structure that all four of you are putting forward. Thank you. So let me ask, though, one question, something we haven't talked about, and that is we were talking about pricing, how the government prices for risk and how the private market prices for risk. And I think it was you, Mr. Davidson, who talked about with millions of mortgages in the Fannie Freddie or whatever its successor is portfolio, the question is how do you price out of that to try to sell off some of that? And how difficult that is when we're dealing with so many mortgages. So the question I want to focus on for just a second is about data tagging. Whether or not you have any familiarity with the idea behind this, the notion that we now have better capacity than ever in the past to tag even something like a mortgage with lots of information about the characteristics of the borrower, information about the characteristics of the originator, and to keep that information with that mortgage we can now do, or at least theoretically we could do, as it's sliced and diced and put into different pools, and keep its performance information always pegging in, so that over time you have this incredibly robust database about performance. Now, you don't have cycles yet until it plays out over longer and longer periods, but you do have incredibly detailed information about how it's working. Does that potential change just in the technology of what we can do now or what we can do in the, I hope in the near future that we were not able to do up through the present, does that give us a better capacity either for the government to price risk or for the private market to be pricing the risk as it buys from the government and therefore solve some of our pricing problem? Any thoughts around that? Anybody? Mr. Swagel?
I think that's exactly right. So I very strongly agree. In some sense, the previous model was you don't need to know any of this because Fannie and Freddie are there.
Yeah.
And so this is just, it's sunlight.
This is like inverting that approach.
So, I mean, Fannie and Freddie just released a tremendous amount of delinquency data that the market never had before,
Yeah.
which, is crucial to price these instruments. But I guess I would caution that, more data doesn't make it more correct data. And so,
What does that mean?
so that, we still have the issue that, if someone's originating a loan, they're writing down what their income is on that document. Maybe it's verified in some fashion, and there's a appraisal. If the income and the appraisal are false because there was fraud, then all of the rest of the analysis you do after that is invaluable. Some of that's problems.
Fair enough, but let me just break in there, Mr. Davidson, just because I'm going to run out of time. It is also the case that you can start picking up the originators that are not the ones who are following the rules, because now you can isolate by originator for whose loans are going sour fast.
Yes, I think a good, representations and warranties and good data about that will improve this whole process.
Good.
It's another hearing, but don't forget second liens in your database.
Good point, Dr. Willis.
Yeah, a neat thing that's going on in developing these mega databases is linking it up with the borrower and the information from credit repositories. I think one of the neat things going forward will be, are there early warning systems in midstream? So you see this guy's credit score has deteriorated. How predictive is that? And splicing these together isn't easy, and there are serious issues. But I think that's pretty neat.
Good. So I hear a glimmer of optimism. Good. Thank you very much. Thank